This question is another one of the what-if scenarios that we encounter with cost, volume, profit analysis in Chapter 5. And so basically what's happening here is right now this company has a contribution margin of $72 per unit, and their fixed expenses are $301,000 per month. They're selling 5,000 units. So let's start out by looking at, what is their overall profitability right now. If you take 5,000 units times a contribution margin of $72 per unit, that means that they're generating right now a contribution margin in total of $360,000. If the fixed expenses are currently $301,000, you can subtract those fixed expenses from the contribution, and you can figure out that right now their operating income is roughly $59,000 per month. But the question is this. The company thinks that they might be able to improve their bottom line by taking some of the salespeople's salaries that are currently in the fixed costs and instead having a commission of $16 per unit. And if we do that, sales revenue should increase by 200 units. Okay, so that's why this is the what-if chapter. Let's see what the difference is. So right now our contribution margin is $72 per unit, but if we add an additional expense into there, okay, 72 minus 16, that means that our contribution margin is going to drop to $56 per unit. Okay? Because for every additional unit that we sell, we're going to have to pay a sales commission to the salesperson. Now, the other thing that's changing here in terms of our cost structure is that our fixed costs were $301,000, but it looks like when we convert from a sales salary to more of a commission structure, then our fixed costs should go down to a new level. We would say that the relevant range has changed here because our assumptions regarding both variable and fixed cost are now different. Okay, so let's figure out what our profitability level would be. So monthly sales were 5,000, but we think they're going to go up by 200. So 5,200 things. The contribution margin is now $56 per unit. So our total contribution margin will simply be the product of those two, $291,200, which is dramatically lower than what the old contribution margin was. As we take it a step further, take that contribution margin and let's subtract our new fixed cost level. So 291,200, subtract the 233, and we see that operating income will be $58,200. Now we can bring it all together here and take a look and say, you know what, at least based upon the facts that we have here, this change would actually cause, not dramatically, but a little bit of a decline in our operating income, because the operating income would be $59,000 under the baseline scenario, and it looks like it would be $58,200 if we made the modification to the sales compensation.